Hello traders, this is Rich from tradesight. This is the market preview for July 22nd, 2014. Here's a look at the results from today. The ES futures and the Nasdaq side were lower on the day by nominal amounts, so it was really just more of a grind than anything else. Nothing really sticking out here except for a little more relative weakness in the Russell, which has been fairly consistent. So that trend is definitely present. Advanced declines were negative on both sides, more or less in sync with what we were seeing. Didn't get anything climactic out of the put call ratio, closed at 0.84, so we're still waiting on that climactic reading. That seems to be pretty elusive. All right, let's first take a look at the Russell. We'll start with the weakest side. The Russell has kind of been the problem child. So let's take a look at what we got. We got 9 bars locked in on the seeker startup phase as of Thursday. So that was something that would try to support the market and at least arrest the slide to the downside and perhaps produce some kind of a reaction to the upside. The subsequent day, Friday, we definitely got a very potent bar to the upside. Obviously, it's really been the strongest upside bar of this whole run to the downside in the seeker startup 1 through 9. Today we had fairly weak day, gap down, really couldn't recover it, and basically just wound up with an inside candle here. So we really need to get back above the 50 and the 6/8 level, and of course the 10 EMA on the short term, just to get back to short term positive. So right now we're at key support, holding just above the 200 period moving average. So we're kind of pinched here. We got to get either above the 10 EMA or lose this 200 period moving average in earnest. But I have a feeling, as we talk about often, that we're just going to wind up gaming this to some degree here. Next up, let's take a look at the Nasdaq side. Nasdaq side had a good recovery on Friday. It was actually the high close of the move, believe it or not. We did trade higher intraday, but Friday was the high close for the contract. So something for the bulls to work with. They really need to get that going. The 13 exhaustion risk level has been broken, so we never really got moving to the downside. We actually had one close below the 10 EMA, but that happened after the risk level was broken, so the signal really never had a chance to go. Again, we had basically an inside day today, so once we resolve Friday's range one way or another, we should get some more clarity. The ES side of the market actually still has this 13 exhaustion warning in play. You see that we'll look at a little different picture here because the risk level is still solid in color, the magenta line, so that means that's still active. Waiting for this to do something. For now, all we've really done is just kind of arrest and stop the movement to the upside. So the 13 effectively just marked the end of the impulse so far, and we've gone sideways here in what's been an extremely resilient market. The one thing that the market's really done a great job of is not getting too overdone. Every time it kind of gets to the cusp of being overdone by all the classic measurements, by the 10-day trend, by the put call ratio, by investor sentiment, it pulls back just before recording that climactic reading where you can say, okay, that's it. We've really got a turning point here, and I can tell you why. I'm going to enumerate it. These are the technical features that are in place. It keeps pulling itself back from that brink. So what we have right now is just a sideways trading range in the ES, which could still roll to the downside, but for now the risk level here, the magenta line, is at 1975 is really the important level of resistance to the downside. We've got near-term support right in the area of about 1955, so we've got about a 20-point band here that we've been in for all these days here, coming up on 2 weeks now. One of the things we talked about was the market kind of saving itself from getting overdone, and here's a great example of that. Here's a look at the survey results from the AAII weekly sentiment survey. You can see the bulls dropped by a full 5%. Most of them went right down into the neutral column. So right now we're actually on the long-term average, we're actually trailing behind as of last week's reading the typical long-term average as far as number of bulls. So we don't have that super exuberant level of bulls where we can point to this as a contrary indicator saying that the market's ready to turn. What we didn't have when we got that 13 exhaustion warning on the Nasdaq and also the S&P side was we didn't have any supporting evidence. We didn't have it from the survey results. We didn't have it even from the advanced declines, which we'll look at in just a little bit here. Here's a look at the weekly advanced declines. It's obviously good to keep on top of the dailies, but you really want to be sure to keep an eye on the weekly time frame as well for the cumulative advanced declines, because when the weekly New York Stock Exchange cumulative advanced decline rolls over, that's it for the market. End of story. You don't need anything else. All you need to know is that, and all you have to do is get the timing right. So if you take a look at the bottom chart here, that's the Nasdaq side of the market. We'll obviously put in a qualified lower high here. We've yet to re-challenge the old high. Nasdaq tends to lead the broad market side, the New York Stock Exchange side. So what happens is when you get a rollover in Nasdaq, a lot of times you won't get the rollover at the same time in the broad market side. That's the New York Stock Exchange side, but you'll eventually get it. Once you do get it in the New York side, then that's it for the market, because the Nasdaq stocks lead. They roll over first, they rebound first because they're more volatile. So what we had here was we did get a rollover in the Nasdaq side. We saw the evidence of that and felt the weight of that in the broad market too, where we did see some very gentle corrective activity, where we did have we had 3 days in a row about a week ago where the Russell was down 3% or more. So that was a pretty sharp move to the downside, and that was really telegraphed by the Nasdaq side weakening. But what we don't have yet is we don't have that spilling over into the broad market. You can see we do have a lower high here, this last reading from the last week in the New York Stock Exchange side, but we haven't broken and rolled over yet. But when this does, that'll be the final vote. This has veto power. When this goes, that's it. We're done. But for now, just want to watch the S&P side to see if it does roll over. The internals last week actually made a new high. This is including this week's data now today, but last week we actually made a new high on this chart. So this isn't showing any evidence of rolling over just yet. Now let's take a look at the major sectors ranked from best to worst. Defense index was top gun. Computer hardware was also pretty strong. Oil services was pretty strong as well. We kind of were expecting that with oil prices ready to rebound from last week. So we're starting to see a little bit of better trade in the oil services. Always want to look at where the transports were after you see the energy stocks, and they were underperforming the market today. The airline index is still pretty weak. That's basically just transports on steroids. So no surprise there. The BKX was a little sloppy, which isn't really great. BTK is still just kind of feeling the effects of being yesterday's news, at least where we are in the cycle right now. But the important thing was the semiconductors are starting to hang in there again. All right, so here's a look at the semiconductors, the stocks on the daily time frame. Made a little bit of progress today. Still going lateral in this range. Obviously, it kind of looks like the chart of the Nasdaq, only with a little bit more relative strength, because we've got this higher high here. We're starting to push up a little bit higher, but we're only 9 days up in the exhaustion run, so we do have 4 days or more of potential higher highs here before we record that exhaustion warning. So obviously the key areas are going to be the lower boundary and the upper boundary of the little mini range that they're trapped in right now. BTK, while we're talking about Nasdaq, really didn't do too much today. Just gyrated back and forth around Friday's settlement. Did not reclaim the 7/8 level, which is important because that's also the 10 EMA. If they do that, then we'll put the 8/8 level back in play. But this is still short-term negative for now. The oil services, fairly strong on the day, but you can see that not really within shooting distance of making a new high. If they do make that new high, we're going to have this 8/8 level to contend with to do so. And we're getting deep in the count here. We're 9 bars up now in the exhaustion run. So we could wind up with that exhaustion warning coincident with 8/8, which is probably going to keep a lid on it for quite some time, or at least multi-days for sure. Next up, let's take a look at the banking index, the BKX. Kind of sloppy again today. Right now, still short-term positive, being below the 10 EMA. 13 exhaustion is in play, but haven't really done much. And you can see it's really using the 50-period moving average for support. Key thing is if we do wind up losing the 50-period moving average, it'll probably also be coincident with getting the MACD line below the 0 level. And when that happens, we'll probably wind up getting some downside momentum. And I would think that that would put that 4-ace level and the 200-period moving average, the green line here, in play very, very quickly. So if we do start to roll to the downside, look for weakness here. We do have this double top in place, and this is actually a lower high here versus the highs that we saw in late March and in early April. So this definitely could be interesting. All right, folks, as always, thanks for listening. This has been Rich for Tradesight.